There's this saying that everybody's a genius in the bull market, but it's the bear markets that separate the best from the rest. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote about 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. I would say that if you've been following the subscriber count on my YouTube channel, I'm getting quite a bit of traction these days. And maybe it's because more and more people are able to distinguish between, the quality of the information that I'm trying to provide on this channel versus the trash information that many other channels are providing. And you see, during the last 12 years, from 2008 to 2009 financial crisis, all the way up till like 2020, the markets have been going up, right? We've been in this long bull market, and this created a lot of geniuses. A lot of people benefited from the stock market going up like this, and it gave birth to reckless investors like Cathie Wood. And then financial media channels like CNBC jumped on it and glorified those kinds of investors, even though they're not really investors, they're just casino gamblers. And you see, the financial media cannot distinguish between investment performance that's purely based on stock prices versus investment performance that's purely on the underlying performance, okay? Just because a stock price goes up doesn't mean you're right on the thesis behind that. The same thing goes, just because the stock price goes down doesn't mean you're wrong. You see, intelligent investing is about predicting and betting on the underlying performance of whatever it is. So if you're investing in Voxter, you are betting that Voxter is going to become a more profitable company in the future, that they're going to deliver on their milestones, and when they do X, Y, and Z, the company is going to be more valuable, and therefore the stock price will follow. And that's especially true if you don't overpay for it. In other words, if you don't pay for the success before the success even happens. That's intelligent investing. Unintelligent investing is not paying attention to the underlying business, not paying attention to the valuation, and hoping that the stock price is going to go up. And then when it goes up, you jump up and down and you tell everybody how you were right just because the stock prices went up. And that's what happened, especially from the period of 2015 to 2020. And then there was, of course, a little bit of a pullback. And then those meme stocks, growth, trash stocks just went to the moon the first few months of 2021. And then since then, of course, they have been crashing. And this has been hard on, some money managers that have been in those names, some influencers, whether it's Twitter influencers or YouTube influencers that have been, talking up those stocks. Now, all of those people are getting smoked, and they are getting a lot of pressure from their followers. That's why I made a video recently, popular video, relatively on my channel, how YouTubers are quitting, financial YouTubers are quitting, or they are under a lot of pressure, or they're depressed, they're changing their strategy because they destroyed the financial lives of the people that followed them. Because if you have stocks that go down 80, 90%, that's tough, right? Like now you have to, if something goes down 90%, which many of them did, you have to now 10x your money just to get back to where you were. And now, what makes you think that you can 10x your money? Especially when you are involved in companies that don't produce any profit. You see, when you have a company that is profitable, let's say a company generates $100 million of net income, and it was trading at, 30 times. So it was trading at $3 billion, right? That's the math. 10 times it's $3 billion, right? And then the stock goes down to $1 billion, right? The market cap at $1 billion. Now you have, it's trading at 10 times net income or has a PE of 10. Do you worry? No. You most likely would buy more because it's a buying opportunity, okay? But now, let's say if you have a stock like Tattooed Chef that loses millions of dollars, is a horrible business, operates in a horrible business, doesn't have any special thing to it, has to have gross profit margins go from 15% 2 years ago to 10%, just so that you can put your product in more stores. That gross profit is not even close enough to cover your SG&A expenses. How do you think that company is going to turn out? It is burning cash daily, okay? The stock is selling off every day. Where do you think the shortfall is going to come from? Okay? It's losing money. So at some point, it's going to run out of all the money in the bank, right? They are going to have to raise more money. Okay? That means selling equity. First of all, you have to ask yourself, who's going to buy that stock when everybody in the world is panicking, right? Who's going to give them money? And if they do, at what terms? Right? The moment people realize, oh, there is a capital raise on the horizon, they're going to decimate the stock even more, causing the company to issue even more shares. Sometimes during those bad times when they have to raise money, the share count can go up 100% or more, just so that they can raise money simply because they're losing money, okay? If they don't raise money or if they have a weak balance sheet, they could literally go bankrupt, those kinds of companies, right? That's what makes it tough, because fundamentally, companies like this don't have anything to provide margin of safety. Value investors are usually the last ones that are going to come in and scoop up the deals, right? Value investors are going to come in, and value investors are going to look at net income, cash flow. They're going to look at, the balance sheet. They're going to look at maybe if the company liquidated nets, right? Current assets minus current liabilities, how much inventory there is, if the inventory was liquidated at a certain price. They're going to make those calculations. But if you have a company like Tattooed Chef, it doesn't have any net income, it doesn't have any free cash flow, they're not going to come in and bail it out, okay? They're not. And all the investors that you have in a name like this are growth investors that were hoping for the moon, and now every day they hear the news, every day the company is losing more money, it's getting closer and closer to diluting. How do you think those kinds of companies are going to recover? How do you think those kinds of companies are going to be able to deliver the performance, even to break even? See, that's what makes it difficult, because time is not their friend. When you are making money, like if you're a company like Alibaba, for example, yeah, you can make a case. You can have people that are always going to support the stock at a certain price because the company is good. The company has good fundamentals, and it will always attract the bottom feeders. It will always attract value investors. Yes, people are going to argue, you're stupid, China is this, China is that, but they look at the fundamentals and they're going to support it. But when they look at the fundamentals of some of these companies that you should avoid at any price, there's nobody that will come in and bail the companies out, okay? So this is why I think that the situation with some of these growth stocks or some of these YouTube influencers that talk about those names, they're telling people that hang in a lot longer. There's going to be a rebound in the growth stocks, and there will be a rebound in the growth stocks at some point. But that doesn't mean the growth stocks that are terrible are going to rebound, okay? I see a lot of those names, what's going to happen to them is what happens with the gold miners. After they crash, they never recover. They just stay at these horrible levels, and then they eventually go out of existence. And people lose money permanently, because it's one thing if you go down 60% and you recover, That's no problem. It's another thing when you go down 60, 80, and you never recover, and you go down even more and you never recover. That's permanent capital loss. That's why Warren Buffett talked about rule number 1, never lose money. Rule number 2, don't forget rule number 1. And that has nothing to do with volatility, because if you just put volatility on it, Warren Buffett loses money a lot. But it's not about that. It's about permanent capital loss. Permanent capital loss occurs when you invest in unfundamentally sound companies and unfundamentally sound investment thesis. So in summary, I think this period of heavy sell-off, I view it as good because it separates the best from the rest. Hopefully, it teaches some people a lesson that just because you're a growth stock investor doesn't mean valuations don't exist. You should pay attention to what you're paying for things. You should pay attention to the fundamentals, and you should realize that there are real businesses behind the ticker symbols.